Hello Accounts 212 students. Welcome to our videos on groups where we're going to continue learning about the consolidation of entities. I'm going to switch over to our slides. Remember, these slides are available on Moodle for your pursual. Okay, a reminder of our lecture structure and where we are at. We are busy with video 4 at the moment. Okay, you should have watched video 1 where we went through and had a look at the theory behind group, then moved on to video 2 where you learned about wholly owned subsidiaries, which is 100%. And finally, you should have just finished looking at video 3, partly owned subsidiaries, where we learned about how we're going to account for our non-controlling interest. Okay, video 4, which is the current video, we're still only focusing on the statement of financial position for now, but we're now going to have a look at what happens after our acquisition. So in videos 2 and videos 3, we have had a look at just on the day of acquisition. So we acquired it on the 1st of January 2020. What would we do on the 1st of January 2020? Whereas video 4, which is the current video, and chapter 5, we're going to be having a look at what happens after that 1st of January 2020. So now we further on afield, we may be in 2025 now. How are we going to account for that time lapse? Okay, so we are looking at chapter 5 of our notes on group financial statements with Keith Prinsloo and Derek Forsyth. We're going to be studying the entire chapter. And this is basically what we're going to have a look through. So this slide summarizes what we're going to be doing in example 5.1. If you're not understanding the process that's on the slide, it should become more clear when we go through the example. So one thing that you need to note is, although you purchase a subsidiary at a point in time, so like we said earlier, 1st of January 2020, our subsidiary is going to continue operating after that acquisition. They're going to make profits, or perhaps they're going to make losses. They're going to purchase assets, they're going to sell assets. They are going to pay off their liabilities. They're going to get new liabilities because of the fact that they are continuously operating. So when we do our initial consolidation, we consider, well, we have purchased a company at a point in time, we've paid a certain amount for it, and we then eliminate the at acquisition reserves, okay, being our share capital, our retained earnings, and any fair value adjustments that we need to make to our assets, as well as any other reserves that we have in equity. So we've accounted for that, but now we have continued to operate as a subsidiary. We've made profits. Not all those profits are necessarily going to go through to our holding company. Reason being, like what we saw in chapter 4, we might not have 100% holding. So if we have 100% holding, it's a lot easier. But if we don't, which is what we're focusing on because that is the more likely scenario, if we don't have the 100% holding and we've only got the 60% or the 70%, we need to show our users that since we've purchased this item, the subsidiary has made so much profit, some of it belongs to us and some of it belongs to our non-controlling interest. So we will be processing a journal entry to remove the remainder of our retained earnings. Okay, we've already removed our at acquisition retained earnings in our first journal entry. We're now going to be removing the remaining retained earnings, which are our since acquisition retained earnings, and we are going to be putting that through non-controlling interest. Okay, but only the percentage that belongs to non-controlling interest. The remaining percentage we can leave in retained earnings because our holding company has actually earned it. Okay, so let's turn through to our textbook and let's have a look at this example 5.1 on page 55, so that we can get a better understanding of this process. Okay, we are looking at example 5.1. Let's read through our scenario. So H has acquired 70%. Okay, so therefore we can automatically deduct that therefore our NCR, non-controlling interest, is 30%, like what we learned in chapter 4. Okay, we purchased it on the 1st of January 06. So remember when we started chapter 4, I said it's very important to note which day we made the purchase, because that's when we begin consolidation. Now note in chapter 4 and in chapter 3, the statements of financial position that was given to us, as well as in the required when we needed to create our consolidation, it was on the same date, this 1 January 06. In this example, we are now looking at 1 January 09. Okay, so very importantly, the first thing I want to point out to you is there has been an elapse of time between 1 Jan 06 and 1 Jan 09. And so therefore this retained earnings here of 70, that is in S's financial statements, you must understand that includes some profit that we have earned since we acquired. Yes, so we can no longer just go straight to our statement of financial position and look at our equity amounts to see what equity is. We need to understand what the equity was on acquisition as well. Yeah, so this next sentence is what is telling us we had retained earnings at 40,000. Okay, for purposes of accounts 212, we will not be having a look at an increase in share capital. So that share capital of 110 that we can see in the statement of financial position at 1 January 09 for S Limited, that 110 was the same when we acquired S for that 165. Okay, our investment amount, and then again, there's our investment amount. So that 40,000 is very important because that affects our at acquisition pro forma journal entry. Okay, our at acquisition pro forma journal entry, remember, is that we need to remove our equity, we need to remove our investment, recognize our non-controlling interest, and then see whether we have got goodwill or negative goodwill. At the date of acquisition, H Limited considered the net assets of S to be fairly valued, with the exception of land, which was 50,000 more. Okay, so remember that is going to affect our at acquisition. Okay, so let's make a note here. Affects at acquisition pro forma journal entry. Okay, non-controlling interests are recognized at their share of net identifiable assets. So we are going to therefore, based on that statement, we are going to find the net identifiable assets, okay, which in this scenario would be equal to our 110 share capital, our 40,000, because it's at acquisition, 40,000 retained earnings, as well as our now 50,000 land. Okay, so add that together, it's 110 plus 40 plus 50, that would give us 200,000 net identifiable assets, multiplied by NCR percentage, which in this case was 30% because we had 70%. And that would then give us 60,000 NCR. Okay, so already we have a lot of information that we can put together in order to form our solution. Okay, so let's have a look at the solution Journal entry number 1 here that we can see at the bottom here. We can see we have debited our share capital of 110. Please note this 40,000 is supposed to be on the debit side. Okay, so we are actually debiting our 40,000 retained earnings, not crediting it. So please move that in your book. And then our land, we had read that we had the 50,000 revaluation, so that will count as part of our net identifiable assets. We calculated our non-controlling interest at 60,000. Okay, that 165 was given to us. And then this goodwill is there for our balancing figure. Okay, so we paid 165, our non-controlling interest is worth 60, that together makes 225,000. Our net identifiable assets that we calculated on the left there, that's 200,000. The difference between our 225 and our 200,000 gives us our goodwill, which is 25,000. Okay, so up till this point, you should be fairly comfortable to be able to do that journal entry, because that's what we did learn already in our chapter 4. Okay, the only difference now is obviously that 40,000 that we got for retained earnings hasn't come from our statement of financial position because we needed to do the at acquisition. Okay, so importantly, this journal entry is at acquisition figures. Okay, every year we are going to do a consolidation. So every year we will get H's financial statements, we will get S's financial statements, and we'll have to do these pro forma journal entries every year. They're not physical journal entries like what we see in our normal accounting books, where once they're processed, they are there. Because this is not actually a physical book that we are doing. This is a working so that we can add H to S so that we can produce our financial statements. Okay, so that is vital to understand. Next year, when we are at 1 January 10, again, we are going to produce this exact same pro forma journal entry. Our next pro forma journal entry will change slightly though. Okay, so let's move downwards and let's have a look at this journal entry. Okay, this should be marked at as number 2. And this journal entry is now accounting for what we call since acquisition. Okay, and in this case, we're looking at profits. Okay, so since we have acquired S, our opening balance of retained earnings was 40,000. In our statement of financial position as at 1 January 09, our closing balance of retained earnings was 70,000. So that means since we acquired S, 30,000 profits have been made. Okay, so remember, when we do consolidation, we go H plus S. Okay, so we have eliminated this 40,000 over here already in the previous journal entry at acquisition because we paid for that. Okay, between the initial non-controlling interest and the fact that we had an investment, it's been paid for. This 30,000, however, has been earned, but we need to divide it between what actually can be shown as what we have earned and what must be shown as non-controlling interests. Because remember, when we looked at our financial statements, we divided it into 2 sections, one section being what is attributable to the parents, the other section being what is attributable to our non-controlling interest. Okay, so this journal entry takes this 30,000 that I've highlighted there, and it says 30,000. %30 is NCI, okay, which is equal to 9,000. 70% is H, 21,000. Okay, so this 21,000 can stay in retained earnings because H has earned it effectively. Okay, so in the liquidation process, that extra 21,000 would come to them. This 9,000 though has to be removed from our retained earnings. Okay, because our retained earnings is telling us what is attributable to our H shareholders. So it needs to be removed from retained earnings and put into our NCI, because our NCI shows us what exactly is attributable to our non-controlling interests. Yeah, from the time that we've purchased it all the way through. Okay, so that is what this journal entry is then doing. Okay, this journal entry here, I said that's actually number 2, not number 1. It is taking the non-controlling interests profit, okay, so the 9,000, and it is putting it from the retained earnings into our non-controlling interest. Okay, so let's move down and see. In terms of our consolidation, remember we take all of H, we add all of S. Okay, and this is as at our time when we have created these financial statements. Okay, so we will still be using the 70. Okay, so it's H at a point in time, S at a point in time. H on the 1st of January 09, S on the 1st of January 09. Okay, the adjustments that have taken place, our adjustment number 1 here, that's our at acquisition journal. Our adjustment number 2, that is our post acquisition or since acquisition profits that we have adjusted for. Okay, so let's have a look at what our solution would look like. Okay, there's our solution. You can see we have equity that is attributable to the parent shareholders. Okay, so there's share capital 550. Retained earnings, you can see, is 921. Okay, that 921 is made up of H's 900 that they started off with, and H's portion of S that they have earned. So since we've acquired it, we have earned that 21,000 that we had on the screen a little bit earlier. Okay, so it's the 900 plus the 21 that we have earned. Okay, let's go back down. You can see our non-controlling interests are 69,000. Before it was just at the 60,000 that we had recognized at acquisition. Okay, now it's the 60 plus our since earnings. Okay, for the non-controlling interest, so plus their 9,000. Okay, another way that you can do this, remember we introduced you to the analysis of equity worksheet, and we had a look at this first line over here. We had a look at that at the end of chapter 4. Okay, so here we are saying there has been some addition of time, so that's what it was on acquisition, so that we can calculate our at acquisition journal entry. So there's our NCI of 60, our investments that we took out of 165, and our goodwill total of 25,000. Okay, the since retained earnings here, we can see at the end of December, we have 70,000. So we must know that therefore we've made some profits, and we can balance it out that S has therefore made profits of 30,000 since we acquired it. That 30,000 is not fully entitled to H. Okay, so we need to divide it between our NCI portion, our 30%, the 9. And you can see we now have a new column in our analysis of equity, which is our since retained earnings. And that is H's portion of S's retained earnings that has increased over the period. Okay, so we'll only have since retained earnings if we have had a lapse of time and we could have made a profit or a loss. It can very well be negative in there, and we would then have since retained earnings. Okay, the alternate is the end product method. Okay, this consolidated statement of financial position here is a lot easier to read than the other one, which was slightly misaligned. Okay, and you can see that what they would have done is for each line there's a working. So you can see there's a 1, 2, 3, etc. And you can see for each line what they have done, like for instance for the land, we have taken our H, we have added our S, and then we have our adjustments that have been taken into account. Okay, so that 50,000 would have been our pro forma adjustment from our first journal entry. Okay, goodwill, there's the calculation. So we calculated that through our first pro forma journal entry. So you should be able to follow where all those amounts came from to get to goodwill. Okay, in current assets, we only had H plus S. Okay, in terms of the equity and liabilities, share capital, we only show the parent company share capital and retained earnings, or the parent company share. So you can see we have only 550 shown as share capital. Retained earnings, we have the 900 plus our share of since retained earnings, that 21,000 that we saw in our analysis of equity and that we worked out when we were doing our pro forma journal entries. Okay, and then working 6, we've discussed how we got to that 60,000. Okay, that initial 60,000, which was over here, and then our 9,000. Okay, and then our last one is just our H, because this is our non-current liability, so our H plus our E. Okay, so that is our example 5.1. Okay, we are going to divulge from this, and we're going to have a look at in chapter 6. Now, what happens when we are presenting our income statement as well? So we've had a look at our statement of financial position only up till now. When we move into chapter 6, we are going to be acknowledging the fact that our financial statements are made up of a statement of comprehensive income, a statement of financial position, a statement of changes in equity, as well as note and our statement of cash flows. So from a second year point of view, we are going to focus on the statement of comprehensive income, the statement of financial position, and the statement of changes in equity. Okay, and those two other statements are going to be introduced in chapter 6. So in preparation of having a look at chapter 6, think to yourself what usually happens. Retained earnings shows all your profits, but in your statement of changes in equity, we start with our opening balance. We show our profits in terms of our income statement, or our statement of profit or loss and other comprehensive income, what's also referred to as the statement of comprehensive income. Yeah, so we have that line where we include those profits, and thereafter we get a closing balance. Okay, we can also have other reserves where we have like an asset replacement reserve, and we've transferred from retained earnings into that reserve. Okay, so we're going to have a look at those kinds of transactions and how we're going to deal with those in consolidation in that next chapter.